Let's get a view on markets, particularly in light of the RBA, which meets tomorrow, and what that may mean for equities. Harry Watt from Shaw Partners and Market Matters joins us now. Harry, good morning to you. Thanks so much for joining us. All right, base case RBA tomorrow. Hit me.
Good morning, Nadine. Yeah, the big one from the RBA tomorrow. Will they hike rates? Will they pause again? The market's actually pricing in that they're done now. So we've seen the peak of cash rates in Australia. We've also got the FOMC, the Fed, later in the week, talking about where their rates might go, and the market's sort of pricing in that they've got one more hike in them as well. I think the market's starting to rally and be really comfortable around where rates are at and how the RBA's gone about it. And maybe they have managed to manufacture a soft landing, which was the major concern, that we're going to see a massive downturn in economic data coming through. But it looks like they're starting to be a bit more reasonable, and they've starting to see the effect of their really aggressive rate hikes over the last 12 months come through the market. And they're sort of looking like they're going to pause at the right time. So hopefully we see the RBA pause. That's what the market's expecting. If we do see one more hike, or if we do see commentary talking to one more hike, I think that'll put a lot of pressure on the ASX and particular sectors, in particular, really. So, for now, I think market's pretty comfortable that we're going to see the peak. I have seen the peak in rates for now, and, we'll see how that goes in terms of flowing through to economic data over the medium term and how that reflects on the ASX.
Okay, but let's talk potentially how that reflects on the ASX. And if I can be so crude to say, would you be investing in staples right now? Would you be investing in discretionary retailers right now with the consumer, with the RBA in mind?
I think there's pockets of both of those sectors that we like. We are across our portfolios, we own little bits and pieces of staples and discretionary. I think you really have to be specific. So you can't really buy the expensive defensives at the moment. I think that's quite hard. You're not really getting a massive yield beneficial for holding something like a Coles or a Woolworths at the moment, given where rates are. Cash rates are sort of they're 3.6%, and Coles is only expected to pay a 3.5% yield. So does that make sense to me? I don't think it does. Maybe there's some growth coming through with population and the like, but for now, I think that's quite an expensive place to be. But drilling down into that sector, there are some other stocks that we do own. We own Treasury, we own Metcash in the staples side of things, and we own Premier in the discretionary side as well. So there are sort of pockets of both that do make sense to hold in this time. Even if we do see some consumer spending roll off, which we are starting to see. We've started to see credit card data and personal loan data fall. And I think that's a sign that, we are seeing some pullback in consumer spending at the moment, Dean.
Okay, so where's the black and white? Where's the evidence? I mean, we did get an update from Coles on Friday. What did you make of it?
Coles was an okay update. The sales numbers were largely in line. It wasn't, a massive miss. I think the most disappointing thing for Coles, it was down about 1.5% on the day on Friday. It's seen a little bit of an uptick today, I think, last time I saw shares this morning. So they were a bit weak on the liquor side, which was quite a surprise to me. They've been doing quite well on their liquor side of the business, and they gave a pretty poor update in terms of how their online capacity is moving forward. So I think that was what really weighed on the stock on Friday. I think that overall, though, the numbers, they were okay. The third quarter numbers for the supermarket side was fine. It might have seen some weakening tobacco sales, which shouldn't be unexpected, given I don't see many smokers out the front of the office these days. That sort of tobacco sales have rolled off, and we should have been expecting that. But overall, the business is in reasonable shape. For us, it's just too expensive. Like I said, 3.5% yield coming through at the moment. That doesn't, screen attractive for a business that's not really going to be growing outrageously well over the next few years. And for us, that's in the hold or sell side for our portfolios at the moment, Nadine.
Okay, so Coles, in the discretionary space, I know that you said that you have pockets that you like in either. I mean, are there any names in discretionary that you're still positive on? I think you guys used to be quite positive on Lovisa, correct me if I'm wrong.
We did. We owned Lovisa for about 9 months there and took a really good profit on that one. We still like it. It just got a little bit too expensive for us, and we switched into Premier. So playing in very similar spaces. They're the smaller ticker items. They're sort of moving towards more of a youthful categories in terms of what they sell, and they've got good balance sheets behind them and good growth runways. So yeah, Lovisa and Premier, they're trying to grow their store footprint. They're trying to build sales in that regard, and they've got the balance sheet to back them up. So both of them should be growing earnings reasonably well. Lovisa was just on the expensive side, so that's why we made the switch, and we're pretty happy to be in Premier at the moment. We see a little bit more upside there. They're going to be moving their Peter Alexander stores internationally, and that just I think gives them a little bit of a free kick. That's a really well-run business, a really specific target market that they know well. So I think that international expansion, the balance sheet to support that behind them, will help them grow earnings moving forward. And I think haven't really seen that in the price at the moment. So really happy to be there. They've got Smiggle, they've got JD, they've got a bunch of other brands as well that they can sort of tuck on, and little growth levers within each of those brands that they can pull. And I don't think the market's quite understanding that and quite pricing that one in yet, Nadine.
Okay, so there's a tip. There's Premier. What about the whole travel scenario? Whether that be, well, I think Hello World was out with an upgrade last week. You got Corporate Travel Management. If you like global expansion, embarking on a very big expansion in Europe and the UK. Do you like any of those travel names?
Travel's interesting. We spoke about this one a week or so ago, Nadine. I
Yeah.
think we we don't sort of comprehend that as rates rise, as pressure becomes on budgets, household budgets, we don't actually see a massive roll off in travel spending, and we are still seeing that roll off from the COVID lockdowns. People are pretty keen to go out. I know about 50% of people I talk to around the office and around my friendship groups, they're all looking at going to Europe or America at the middle of this year. So there's massive travel spend coming, and there's massive travel spend leading up to that as well. And we're starting to see that come through in the numbers. Hello World Travel came out with an upgrade late last week. Massive upgrade for these guys. Their third quarter was huge. That's 14 million in underlying EBITDA. Their biggest, I think, the biggest surprise to the market was their margins. Their EBITDA margins got over 30%, which is a massive uptick from the low 20s they had in the first half. And they see that continue into the fourth quarter as well. They look well and truly on track to meet or even beat this latest upgrade of their earnings, their EBITDA expectations. They don't even need to do what they did in the third quarter again in the fourth quarter to hit that top end. So they're running really well. They've had a really good share price performance coming out of those January lows as well. But looking out, they look like they're in an upgrade cycle, and we can see further upside from these guys. I think they're also pretty cheap. You put them up next to Corporate Travel or Flight Centre, they're very cheap. They've got basically no debt on their balance sheet as well. So, overall, I think that's a really good business that's done well. It's been a little bit discounted heading into this period, and we've seen that rip and markets had to, change their positioning in the stock. And I think that's something that might have to continue as well if they continue to upgrade earnings, like I believe they should.